Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a great day here so far. I got a good one for you today. Do you have some pre- and post-tax money in your traditional IRA, do you? Well, it's an old David Letterman thing. You ever hear him say that? I'm that old, by the way. I know some David Letterman. I was actually on the show. Anyways, if you have pre- and post-tax money in your traditional IRA, I got a warning for you here today. It's a little sort of misconception. People handle this a little bit wrong, and I'm going to share two examples from two people who agreed to let me share their story with you. The first is actually from a customer, a potential customer who chose not to join us here at Jazz Wealth. He had $400,000 in his account, and he wanted to move the pre-tax money into the Roth IRA, or the post-tax money into the Roth IRA. So it happens over years. You know, maybe you had a 401k at work and you were contributing to your traditional IRA as well. Maybe you made too much money along the way and you weren't able to deduct those traditional IRA contributions. Well, it's natural. In your head you go, then I want to move it over to the Roth, right? I got pre-tax money, I got post-tax money. I'd like to go ahead and move that money over to the Roth and leave the pre-tax, right? But if I wasn't able to get a deduction, right, I didn't get my money back for that, or the tax money back, then why would I want to leave it in a traditional IRA and pay tax again on the way out? Technically, I'm taxed twice, would I not be? So this happens, right? All the time people ask this question, but I want to give you two examples here because if you get this wrong, like investor number one, it's going to hurt you a little bit here. So here's the thing. If you have a pre-tax and post-tax money in an IRA, the IRS treats all of the deposits in aggregate. You actually can't specify which money you'd like to move and label it as post-tax, right? You have to use all of it. So here's what the first guy did. This one hurts a little bit, but he had $400,000, like I said, in his IRA. Of that, he says that $300,000, he took really good notes, but it was about $300,000 was pre-tax and $100,000 of it was the post-tax. Now this is the money he wanted to get over to the Roth IRA, and I don't blame him, right? Because it gets to be a bit nasty in there. You're mixing all these deposits together. If you're not taking good notes, then you might miss out. But again, the IRS says, you know what? You can't just pick this and put it in the Roth. We're going to use everything in aggregate here. And so that's just the fancy word that they use there. But here's how this works out for him. What he did is he said, look, I called Vanguard. That's where he had his account. They didn't really have any help that was free for him. So he just said, I have $100,000 in post-tax money. I'm going to go ahead and put that into the Roth IRA. Well, I spoke to him last week, and he was panicking because his accountant was panicking, and the IRS was now panicking, or is about to panic, because he didn't do it right. So what happens here is because he put the $100,000 into his Roth IRA, $100,000 is only 25% of his IRA. The IRS looks at everything and says, how much money did you have in there? Okay, he had $400,000. 100,000 of it was the only post-tax money. It goes into this, it's 25%, which in reality, the $100,000 that he put into the Roth IRA, since it's 25% of his total, he is only allowed to deduct or not be paid tax on 25% of that conversion amount, right? So in reality, $75,000 is now taxable to him. That sucks. I don't know how else to say it, right? So $100,000 goes in. He thinks it's all post-tax money, but in reality, the IRS used all this as well. 25% of his total IRA went into the Roth, and so because it was 25% of that, he's only able to take 25% of the $100,000 and count that as post-tax. He's going to have a tax bill of $75,000. It's not going to be pretty. Add to that, what really happened, the honest truth here, what really happened is he later tells me, I already have the Roth. It's already set up. He goes, Dustin, what if I just transfer the Roth to you, right? You manage that and then you help me fix all this other stuff. I'm like, oh, gee, thanks, right? So he says, I've already got $50,000 in the Roth. So in reality, he didn't have $400,000. He had $450,000. He forgot to tell me about that piece there. So now for 100,000 into 450 is 22%. His tax bill just went from $75,000 to $78,000. Makes it a little bit worse there. So be very careful there. All of your IRAs count. You know how I tell you guys, if you make contributions to your Roth IRA, you can have multiple Roth IRAs, but they all count together. Same with this, all right? So let me give you another example here, because this is, I know I wanted to do a few of these here. I normally don't go this long on these videos, but this one's really sticky. I want to make sure you guys, definitely get it. And of course, if this is happening to you, I'm happy to help. But here's another example of a customer. Smaller dollar amounts. From 2000, and this is Michael, by the way. He said it's okay that I share this with him as sort of a lesson, custom video here from Michael. Between the years of 2015 and 2018, Michael has made $13,250 in total contributions to his IRA, right? He never had the Roth yet. Michael comes to me and says, Dustin, I'm ready to get started. I have two things I want you to do. Number one, I would like to put in $7,000 into a Roth IRA, get everything up and running, make my 2019 contribution. Then, Dustin, I want you to take my non-deductible contributions and I want you to put that into the Roth IRA, because I have a total of, what would he say? What we figure, $3,930 is non-deductible, right? So this is going to be his post-tax, essentially, right? And he's saying, out of the $13,250, I'd like to take that $13,930 or $3,930 and move it. And I said, okay, well, wait, right? Now you guys know what I'm sort of about to say here. Because he's going to move this much money, right? If he does it right now, then that works out to be, well, it's 30%, just about 30% in there. So 30% of this is going to be counted post-tax, right? He's going to owe tax on the rest, which happens to be $2,751. That's not so bad, right? That's like $724 maybe, no, $604 if he's at the 22% tax bracket. So if he just does this right here, and he says, I got $13,250, $3,930 was post-tax, that's 30% of my IRA, right? I'll have to bug him and make sure he doesn't have another one. Then that means $2,751 is taxable to him. The rest, the $1,179, is tax-free, okay? Very, very important, right? This is just the littlest thing. You find out how you can get in some serious trouble here. Now, when asking about this, he's like, look, you take this, Dustin, start with this, right? Let's do this conversion. But in the meantime, while we're waiting on that, I want to put $7,000 into my Roth IRA. You know what the answer is? No, don't you dare, right? Don't put the $7,000 in yet. See, the IRS will calculate the value of this account as of the end of the year. But you can still contribute for the previous year into a Roth IRA, and even though we're in a new year, right? So what we really want to do is hope the market falls for him here, right? And maybe the value drops to $12,000 or something. And right before the end of the year, we end up or maybe beginning of next year, we do the conversion of this amount, and maybe it's a smaller amount. Then, right? Then put the Roth IRA money in there, because he's got $13,250, right? So if right now he's got $13,250, and before we do anything, if I allow him to put the $7,000 into the Roth IRA, right? That's $20,000. Now we have to use $20,000 when we do the conversion. So he only wants to convert the $3,930. Well, if we do it that way, right, and we end up doing it where $3,930 goes into $20,000, now we're at 19%, right? Which means, I did the math earlier, as you could probably tell, $556 would be the only post-tax amount that he could convert. Now all of a sudden he's got to pay $724 in taxes versus only the $604. So it's not a huge savings, right? He may opt to just say, oh, just dive in, Dustin, just do it anyways, I don't care. But the bottom line is, on these sort of smaller numbers, well, it makes a difference to us, right? If we're just getting started and we have very little, then every little bit counts. For the poor guy that ended up converting and shouldn't have done that, what could we have done differently? By the way, before I leave you here, let me just throw this at you. You want to really geek out with me for a second. And I won't say his name, but Guy, if you're watching, this is what a fiduciary would do for you. So remember, he had the $400,000, and of that, he had $300,000 in pre-tax money. Remember the whole example we just went through. Here's an idea. What if instead of saying, okay, we want to convert $100,000 of it and finding out the tax bill that we went over a minute ago, what if we got with his 401k company? What if his 401k company, if he had a 401k, what if they would allow him to roll this into his 401k? Hang in there, right? Stay with me. So this is a little geeky. So he had $400,000. 100 was post-tax. But if we could eliminate this from the view of the IRS, legally, if we could eliminate that from their view by putting it in his 401k, would he not be left with $100,000 in his IRA? Now, if we said we have $100,000 that we want to convert, right? $100,000 of the IRA is post-tax. Would we not be telling the IRS we want to convert the entire amount? Could we potentially have eliminated the entire tax bill on that thing? I'm not going to say yes or no because there's too many variables there. Figure out tax bill, or does he have to pay the $78,000? There's no way he should have paid the $78,000. And so that, ladies, one of we are financial, or whether hundreds of thousands matter to us. Advisory firm.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.